Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's show, we have Kirk Spano. Kirk Spano's back. Kirk, thanks for joining us.
How are you doing, Brian?
Doing great. Always great to have you on the show. And Kirk, you recently, I guess a few weeks ago, wrote an article on Seeking Alpha entitled Revamping or Starting a Portfolio Now, and is one that I enjoyed and got a lot of attention, and you were kind enough to join us to discuss it today. And obviously in the last month, there's been plenty of other things that have happened, discussion worthy, so I'm looking forward to diving in. So
does that mean we're going to get to talk about my poker career?
Hey, you know what? If you steer in a direction, it may take me a few minutes to retrieve the conversation. So if you want to do that, go for it. But,
yeah. Well,
sorry. Is that your way of saying you want to tell?
Yeah. Let's talk poker,
people
man.
What you've been up to for the last month? Okay. Everyone wondering why Kirk has not written an article in a month. Kirk, do you want to tell everyone why you haven't written in a month?
I actually spent 3 weeks in the desert in Las Vegas. And playing in the World Series of Poker and some other tournaments. So I am officially a very bad professional poker player. I actually am putting together a series of articles titled Poker Investing in 3 Weeks in the Desert that'll start coming out here in the next week or so on Seeking Alpha. And it's going to draw analogies between poker and investing. And I think they're good analogies. And other people have loosely talked about this sort of thing. And you know, a lot of the hedge funds now, they take their finalist candidates and they make them play a poker game.
I actually did not know that.
Yeah, so there's several hedge funds doing that.
What's the theory there? Just to see how well people handle pressure, or what?
Partially pressure, but partially it's game theory, right? You know, who knows when to make the right bet, and that is a huge analogy between poker and investing because there's an element of luck in both of them, right? But
sure.
If you have the same people winning over and over again in poker and the same people making the most money in investing, clearly it is skill that is the ultimate differentiator. So the two skills, which is when to push in with your investment money or with your chips, seem to have a high correlation. And you could probably find a video on YouTube that talks about a hedge fund that does that. It might be a 60 Minutes episode or something.
Interesting. You know, it is, I know this is not quite what you're talking about, but, I met a guy a while back who basically was like professionally counted cards for a long time and ran a team who did that for a long time and did really, really well on it. And
right.
Which again is not quite the same thing, but they're in a game of gambling, they found a skill set dynamic that allowed them to win consistently. And obviously the casinos didn't like it, but I guess that's one way of showing it can happen.
Yeah. Well, and that was actually blackjack.
Okay.
Yeah, that was blackjack. That was counting cards and varying your bets based on the weighting of the deck at a given time. So the casinos counteracted that by going to, instead of single deck or double deck blackjack, now they have shoes with 6 or 10 decks, and they can even do perpetual shuffle now. So you really can't beat the house on blackjack anymore,
right?
Because there's no way to count the cards anymore.
So, are the rumors true that you're actually raising a fund to help sponsor your gambling? Is that true? Did I get that wrong?
Yeah, it'll be based in a non-extradition country.
It's like based out of Macau or something like that.
Yeah. No, I'm afraid they'd take my money, but maybe I'll find something in Central America. Wasn't McAfee holed up somewhere down there?
Maybe so. I don't know. Maybe no. Maybe you can base yourself out of the Cayman Islands like Alibaba.
Yeah. Right. Bad things are going to happen to a lot of those companies someday, and nobody believes me. Of course, when it happens, then it'll be like, oh, somebody else said it. But, whatever. I've called 2 of the last 2 crashes, and I'm getting ready to call the next one. The hashtag Crash 2020. Check that out on Twitter. That's me. Crash 2020. It's coming.
So you're calling the crash of the .com bubble, then the financial crisis, and then 2020, huh?
Yeah, made a lot of money on the second one coming out. I broke even, give or take, on the financial crisis. Broke even, give or take, on the .com bubble. I actually was buying Occidental Petroleum, which I'm buying now, Petrobras, and zero coupon bonds back in like 1999 and 2000. And I had people in my office telling me I was crazy because why? Because it's different this time. Those are pretty dangerous words, aren't they? I know you appreciate that.
I do. And so on our theme, which this fits in well, revamping or starting a new portfolio now, walk us through it. Like you wrote the article about a month ago. I'm sure maybe a few things have changed, but I'm sure not that much.
No, the concept's exactly the same. Is that, you have new investors out there, and then you have old investors out there, and there's this idea that, if you're 60, your portfolio should be a lot different than if you're 30. And the reality is that that's not true. A good investment is a good investment. Maybe you won't buy as much of it. Sorry about that. When you're 60, but a good investment is a good investment. And, right now, bonds in general are bad investments. So if you're 60, do you really want 20 or 30 or 40% of your money in bonds just because you're 60? They're bad investments. You don't want them. So to rebuild a portfolio or to start, if you're a millennial and you're just getting started, there's just a couple of key concepts that if you applied these concepts 20 years ago or 40 years ago or 60 years ago, it would be the same concept. It just applied to a different historical paradigm. So the first thing you want to do is you really don't want what I would call old economy stocks. And that's relative to where you are today. So today, I'm telling people the old economy stocks are the ones that are highly capital intensive, that have no moat around their business, and in general are overpriced and indebted. So if you have companies that are spinning out widgets that are similar to somebody else's widgets, and it takes them a lot of money to make those widgets, and they have a lot of debt and obligations, you want to get rid of those companies. And no matter what they did 20 and 30 and 40 years ago when those widgets were the next new thing, right?
So what are, like, you're saying this and there's different companies and ideas coming to mind. Which ones, what are some examples?
Well, you can take a look at valuation and find some out there. I told everybody to sell Caterpillar a while back. And what did Caterpillar just do, right? It just fell out of bed. So, there are certain companies out there that they're so capital intensive that you don't want them, because if they're not making something that's incredibly specialized that other companies can't make, you're going to get in trouble. And, there's whole sectors of the economy that are falling into that capital intensive, too much competition, and secular trends are against them. One of the places I keep pointing out, and I keep getting told I'm wrong, even though it keeps showing that I'm right, is the deep water drillers. The deep water drillers like Transocean and Ensco and Diamond Offshore, Nobel Corp, and there's probably 10 others. They are never, ever going to rebound. And I try to explain this to people, and I say, yeah, but oil prices are going up, so they're going to drill, baby, drill. And the answer is no. We are at a different place in history. We are near the end of the oil age, or at least at the very beginning of the end of the oil age, which I talked about a few years ago. So back then we were maybe in batting practice for the first inning. Now maybe we're in the second or third inning. And, there's still plenty of time to go, a decade, 15, 20 years to go. But to drill in the deep water of the ocean, which is about all that's left, right? The shallow water and even a lot of the medium water has been drilled. So to do the more expensive projects, you have to sink hundreds of millions and probably billions of dollars into a mega project or at least a large project that's offshore. Well, so you have to make $1 billion or $2 billion or $10 billion back before you're even, right? Before you're even. What financier wants to finance those projects knowing that demand for oil might turn over 10 or 12 or 15 years from now if the break even was 8, 9, 10, 11, 12 years from now, right? Because they'll never become profitable. There'll never be excess profitability there to drop to the bottom line, because they're going to have to spend the first 7, 8, 9, 10 years just getting back to even. And technology is against that industry, right? Electric vehicles are getting better and better and better. Solar energy is getting better, better, and better. Cheaper. Batteries, better and cheaper, right? So can you tell me whether or not there's going to be a big technological breakthrough in 2 years or in 3 years or in 4 years that really accelerates electric vehicles? Can you tell me that you're not going to have governments of the world start to decide and grant? And remember, 90 some odd percent of the countries on the world signed on to the Paris Agreement. Can you tell me that there's not going to be laws passed outlawing internal combustion engine vehicles at some point? You can't tell me that, can you? Why? Because we already know those laws are coming. It's happening in China. It's happening in India. It's happening here in California. So that's an industry where I'd say 20, 30 years ago, take a look at the charts. You did great in the offshore drillers. They're never, ever coming back. Sell them during this little boom in oil. It's going to be the last bull market in oil. Sell those stocks now. Preserve what capital you have and go buy the short cycle drillers or the short cycle E&Ps or get into technology.
So buy the short cycle drillers and E&Ps. What do you mean by that? Short cycle.
Long cycle is those big mega projects offshore that take forever and ever to pay back. As opposed to
fracking and stuff.
Right. Short cycle is fracking, which they can have it drilled within 3 to 4 months and producing oil, and they're even a year out, and then everything that well produces for the next 10 years or 12 years, even though the volume goes down, is all profit. Right. So if you know that you're even on a project within a year or so, and everything else is gravy, you're in. But if somebody says, yeah, hey, let's go drill off of Angola, and somewhere around the 10th year you're even, hey, what do you think about electric vehicles? Are they going to get here by then?
Right.
Even if they don't get here until the 15th year, what's my opportunity cost to only have 5 years of profitability? So that's why offshore drilling is never coming back. So I think that's the best example of an old capital-intensive industry that's probably never going to do well. Caterpillar is very cyclical. You can trade it. I think it's got a long way to go down, 20, 30, 40, 50, 60, 70%.
Okay, so for example, just out of curiosity, so Caterpillar, you mentioned probably highly capital intensive, no moat, overpriced, indebted, all those type of things. Mm-hmm. So I guess the primary thing is Caterpillar, it's not that their products aren't needed anymore, it's just that there's enough competition that they're not special. Is that basically the problem?
Well, not only that, but their products are needed a lot less, right? Because coal is going away too. So ultimately...
So mining was a big use of their stuff. Exactly. When I think Caterpillar, I think construction, which is obviously not their full usage.
Which is a big deal. And they did make huge moves to get out of coal in the last several years. But the reality is that there is an inventory of heavy machinery on the planet that's just... you're not going to replace it. It's just not going to get replaced. Caterpillar has gone from like $60 a share to $160 a share in 2 years. And now it's back down to what, 138, 139? It probably can round trip all the way back into the 60s. Do you want to be a part of that round trip? I don't.
Right. So I'm curious... And it also sounds like this may be an oversimplification, but the companies, the old world company, old economy stocks, it sounds like a lot of the typical dividend growth investing companies may fall into that category. I mean, it's maybe that's oversimplified, but is that kind of what you're getting at?
Yeah, absolutely. And I know that one of your guys wrote an article that old man, because from this article came the phrase old man stocks, right, or grandpa stocks. And one of your guys that you work with wrote an article that people should be investing in grandpa stocks. And I just, I'm from farm country, so I'll say BS, but you know what I'm calling. I'm calling BS because a lot of those stocks are no longer dividend growth stocks. Their dividends are only growing because of financial engineering. They don't have revenue growth, right? They get a tax break, so they're doing buybacks, and that artificially increases their earnings per share temporarily. These are not companies. Coca-Cola. I'll throw Coca-Cola out there. I don't want Coca-Cola no more. I mean, I actually wear a T-shirt and I drink the drink, but Coca-Cola is not a dividend growth stock anymore because they simply don't have growth. They have a dividend, but they don't have growth. Take a look at their revenue over the last 10 years. Go across any of these companies that people call dividend growth stocks and look at their revenue. And then realize that we had the lowest interest rates in history ever, not in 20 years or in 50 years, ever. In the history of mankind, money has never been free before. And we had a decade of free money. And they ramped up debt, and they made capital expenditures, and now what? They got a tax break that's going to run $1.5 trillion deficit next year in the United States. It's never going to get much less than that if we keep those new tax brackets. So eventually, the piper is going to come calling, right? So all these companies that have run up debt, they haven't increased their revenue, they haven't changed to millennial tastes and emerging market tastes, they're in trouble. Now, how long does it take for trouble to get here? Your guess is as good as mine, right? The market can be irrational a very, very long time. And, eventually there's going to be a comeuppance to a whole bunch of retired people who think that dividend growth stocks that they own really are dividend growth stocks. And really what they are is financially engineered dividend stocks. And when that financial engineering doesn't work anymore, it's going to collapse upon itself like a building without girders.
Well, and I've heard arguments like this for other companies like General Electric, for example. Of course, this was before they had their big sale, and I've looked at their statements to see how much that helps them. But similar type concern, that basically the amount of money it costs them to service their debt or the amount of money that profits they actually bring in and their debt service, what it costs to service their debt are actually really, really similar. And
there's some guy on this show today who wrote an article late last year when GE was in the middle to upper 20s that GE was going to the teens and would stay there a long time. It's that sort of thing. Philip Morris. When I told everybody Philip Morris was in trouble 7, 8, 9 months ago, they all told me I was incredibly stupid because of what Philip Morris did and Altria did. We was talking about Altria, actually. In my head, it's still Philip Morris because I'm that old. I know you're just a pup. But, 20, 30 years ago, Altria, they came through the lawsuits. Well, kind of. They had to split up and take advantage of offshoring some of their businesses and different international tax breaks. But can they get over the fact that people just aren't smoking as much? Mm-hmm. Can they really get into other sin stocks when people aren't drinking as much? Right? Are they going to finally get into marijuana? Maybe, but I'll tell you what. I got a feeling that marijuana is not going to be quite as big as people think. It's all the rage right now because, hey, it's brand new. But there's first mover advantage for the states that did it first. Once everybody has some form of legalized marijuana, who's really going to have marginal profitability there?
Well, okay, so we talked through the negatives, essentially, the things to avoid, the old economy stocks. You mentioned some specifics like Caterpillar, Transocean, other offshore drillers. And you mentioned Coke and GE, Philip Morris, Altria. In the positive side, you said short cycle drillers, for example, those in fracking and EPs, and then technology are where you want to be instead. Is that a safe summary of kind of where you're coming from?
Yeah. So, on the fracking side, and that's not even going to last that long either, several years. As soon as it becomes more expensive to frack, and it will because they're moving to the tier 2 drilling sites over the next several years. Even those opportunities will go away. So you still have to pick out the best of the best among the frackers. And the one that I keep throwing out there is Occidental because that's a legitimate dividend growth stock. And then you have, companies like Pioneer, which is going to become exclusively Permian Basin, and Encana, which has 4 great plays, including 2 gas plays up in Canada. So, there's certain companies out there. Jeffrey Gundlach, a couple months after I said that the Spider oil and gas production, exploration, and production ETF, XOP, was a great way to just play the field for a while. and I agree. I think it's the easiest one to do if you're not going to pick out stocks. You buy XOP, you get 35 EMPs, and there you go. You don't have to worry about it. But at some point, you'll have to sell them because even their earnings will level off 2, 3, 4 years from now. But the real place to make money is in technology, right? And it doesn't have to be the sexiest technology. It can just be anything connected to the smart everything world. You've got IoT, you've got blockchain, edge computing, artificial intelligence, virtual reality, augmented reality, eventually quantum computing, tied to industries like smart cars, smart homes, smart buildings, smart healthcare, smart government, which hopefully justify those tax breaks, alternative energy in the smart grid, right? So if you can get involved in the things that are actually showing positive revenue growth, they have some moat around their business because the technology is somewhat protected. Take a look at them. They're out there. And here, I will give you a company that some people call a grandpa stock, and I'm telling you, there's 3 of them actually that are not going to be grandpa stocks, and there's a huge catalyst to drive them up in price. The telecoms. AT&T, Verizon, and CenturyLink all are going to make all kinds of money on 5G. Now, who's going to do the best? I think it's AT&T, but Cody Willard, who used to throw something up here on Seeking Alpha, I think he's mainly just market watching Street.com now. He's saying Verizon, so I got a little bit of Verizon too. Now that content is getting bought up, and everybody steals it or takes delivery, through their Fire Stick or their jailbroken Fire Stick, or how they get it. The rate at which people are stealing content is off the charts. So, who's going to make the money there? It's going to be the pipe owners, right? So instead of AT&T or Comcast, Comcast is another company I throw in that group, charging you for a cable package, they're just going to say, look, it's $99 for your internet connection.
Right.
So they'll raise the price of the internet connection. They're already doing it.
Right.
Because to get more bandwidth, they say, well, you were getting 20 or 30 megabits or whatever you were getting. To get 100 or to get 200 to get 400, because if you're doing gaming or you're doing streaming, you need more. They're going to charge you for it.
Right.
So as people go to Roku and Fire Sticks and whatever other add-ons that they're going to get on their Android devices, or through Apple TV or whatever it's going to be, the companies that own the pipe, that own the bandwidth, are just going to say, hey, this is what you're paying for it. So AT&T just had 2 price increases. One was just a segregated fee for like $1.75 a month on everybody's bill, raises $1 billion a year. Right? $1.75. Yeah, who's going to complain? Then the other one is they've been given such a good deal on DirecTV Now, which I subscribe to. I think DirecTV Now is outstanding. You can tier it however you want. For $21 or $26 a month or whatever it is, I get all the basic channels that I want, right? And then I have a Fire Stick, so I can order movies if I want to order movies, right? And then I have a couple add-ons where if I want to watch, Asian news, I can watch Asian news, because I don't know how I would pay for that anyway. But
what makes me think too, with the cord cutting that's gone on, which I've loved personally because I loved getting rid of cable. It was fantastic and has saved a lot of money. But I do believe, I think I know what you're saying, in that basically over time, whatever savings may have historically happened from cord cutting is going to end up leveling out over time, because you're just think, well, I didn't want 500 channels, but I do want ESPN, and I'll pay $15 a month for it. Whereas technically I was paying $5 a month before, but now I'll pay $15 without all the other stuff. And eventually it's going to end up, look, I'm still paying almost $100 a month when you add up Netflix and Hulu, internet bill, Amazon Prime, all that kind of stuff.
Right. And I will give you, if I can find the ticker, so Spider has a new communications ETF, XLC. Take a look at the holdings in there. Now, top couple holdings are Facebook, Google, Activision, right? Electronic Arts. But then all of a sudden you got Comcast, Walt Disney, Verizon, AT&T bundled in there with Netflix, 21st Century Fox, Twitter, CBS, CenturyLink, Take-Two Interactive, Viacom, Discovery, Dish. So they took the technology and the telecommunications sectors and they completely rejiggered them. And technology is once again technology, and anything communication is going into this basket. Well, this basket, XLC, Communication Services Select Spider. It's going to replace the telecommunications one. Includes Facebook and Google.
It's interesting.
Google's one of my favorite stocks. I think it's a top 10 company on the planet. Maybe it's first. I right there with Lockheed Martin in my viewpoint. But take a look at the holdings on here. Yeah, Verizon right next door to Facebook. How come? They were never next door to each other before. So as people pour into this ETF, largely because Google and Facebook are at the top, who gets dragged along with more shares getting bought? It's all these other companies, right? That were getting ignored as telecom companies. So there's even a catalyst that is structural in the nature of how they're doing ETFs now. So you got a Spider Select ETF that's putting Facebook and Google together with AT&T and Verizon and Comcast and Netflix and CenturyLink. Now all of a sudden you have to go, that makes a lot of sense, but they were never bundled together before. Are people going to want this ETF? I think they are.
Yeah.
They're going to say, I love Facebook. I love Google. I'm not a big Facebook fan, but I think Google doubles or triples from here in the next several years. I think AT&T, which has been in a range from the middle 20s to the low 40s since I was in college, maybe. I don't know. It's been a long time, 20, 30 years. I think they're going to break out of this range, go through the low 40s, and that'll become the new support, right? Resistance becomes support. And the new range for AT&T in a few years is going to be from the low 40s to the 60s somewhere. And it's kicking out a 5% dividend. And by the way, they keep finding ways to make an extra $1 billion here, extra $1 billion there. They're going to save billions on the synergies of the company. They're going to get all the DirecTV. I'm telling you, DirecTV now is going to be a big deal because of the integration of Warner Media. So, maybe they turn around and spin that back out, and then that's a big hunk of money that falls to the bottom line. We'll see what strategic transactions come down the road, but I like AT&T the way that they're vertically structured now. It's the same reason I like companies like Potash. People say, well, Potash is a grandpa stock. I said, not really. They just spun off their 1/3 holding in SQM, which was lithium. Lithium's not old, isn't grandpa. That's EVs. That's electric vehicles. So you actually have to know the businesses that you're invested in. I know that Warren Buffett says this all the time, and I know it's just kind of passé to say you have to know the businesses that they're invested in. But, man, you and I both know that 80% of the people who invest have no idea what these companies do. It's a pretty important thing.
Yeah. Tell me this, just not to get off the topic too much, but going back to AT&T, I think one thing that will be on people's minds, obviously the big merger that's in process, I guess, and the huge big debt loads that AT&T is taking on there. What are your thoughts on that? Much concern? Think the revenues are going to be able to cover it?
Well, the revenues already cover it in spades, right? They're not borrowing to pay the dividend anymore. So if you have the revenues to cover it, then the revenues cover it. And if you are a quasi-monopoly, right? These telecoms are all part of they're an oligopoly, right? There isn't 100 of them. There's 6. So 6 or 7. So they'll be able to keep the prices higher. And they'll be able to charge what they need to charge. If at some point they're too expensive, maybe we regulate them like a utility. And then at that point, they start spinning off all their content companies. So it's hard to know how the cycle plays out over the next 10, 15, 20 years. But what we do know about AT&T is that their cash flow is more than enough to cover everything and then some. And by the way, their pension's just fine. You might want to go talk to Verizon and see how they're doing.
Wow. Kirk, as always, this has been fantastic. And of course, before I cut you off, I want to make sure there's nothing left you're going to say real quick. We can talk for hours, of course, but this has been really helpful in terms of getting a feel for what to be wary of and what to look forward to. Any final parting words you want to give us before we sign off?
Nah, if you're not following me on Seeking Alpha, I know I took quite a bit of time off in June just to recharge the batteries. If you've been listening, you might be able to tell that the batteries are pretty well recharged. The articles on poker investing and 3 weeks in the desert, I think, are going to be fun. But I'm also going to talk about why, at the moment, I'm a net seller. I'm a net seller in this stock market, and I've got most of my clients and subscribers between 25 and 40% cash right now. Not because I think the world is coming to an end, but because certain things are so uncertain right now that the headwinds, if you are actually a risk-averse investor, you ought to be taking some of your profits.
Okay, well, we have to pause on that for just one moment. So can you just briefly give your thesis on why now as opposed to a year ago or whatever else are you having that so much caution?
Right. So you have several things that are happening all at once, right? The first thing is we know that when the Federal Reserve and the central banks become less accommodative, eventually the markets and the economy start to slow down. We're starting to see some flattening. We're not seeing anything turn over just yet. However, we also have the complication with oil going back to a more normal price. I said back in February or March that we were going to find a Goldilocks level for price on oil, and that's happening. We're controlling the price of oil. Go over to MacroView and listen to some of their interviews. We're controlling the price of oil somewhere in the 70s, right? I said it would get to 80, and it'll probably sniff 80, get over it here and there, but there's enough capacity to keep oil from getting much higher than 80 for a while. Everybody makes money. It doesn't damage the economy, but we don't have the headwind. We don't have the tailwind of super cheap energy at the moment. So that's going to be a bit of a problem. And then finally, I know a third of the audience loves Donald Trump. President Trump is the president, and we should respect that. However, I don't think he's doing everything just right. And I could be wrong, but typically I'm not. And I think that these tariff wars that are going on could become a big problem. Now, that said, back in February, March, I said to expect positive surprises on trade. In the last couple of weeks, especially this week, I've become a little bit less optimistic. And so I'm pulling in the sales a bit and trying to take some profits. Last year I posted how much I made last year. We made 48% last year. This year we were up 14% at the halfway mark, probably about 16% a couple more weeks in. And that's with oil not cooperating at the moment. I am taking that money away. I'm taking that money off because I just think that the headwinds, the tailwinds are turning into no winds, and the no winds are turning into headwinds, excuse me. And I'm just not as confident as I normally would be. There was a pretty good article on Business Insider, and I'll have this chart. I'm going to steal the chart and I'll cite it, but the Citigroup analyst showed how the marginal buyer within the market is disappearing. And that's very important because the money from QE is no longer flowing to the primary banks, which means no more cheap money to buy stocks. And China, which was a huge marginal buyer of stocks on every dip, they're not doing it anymore. They're keeping the money at home. So, I think the final straw is going to be the buyback bubble bursting. And I wrote about that. You can go to an article titled "The Buyback Bubble Will End Badly" back in March. I got criticized for that. 176 comments, a lot of them negative. But what do we see today on CNN? What do we see today on CNN? The captains of corporate America are steering a record amount of cash into stock buybacks, but they're selling. Insiders dumped $8.4 billion of their shares in May and $9.2 billion in June. That is the biggest 2-month period of insider selling in years, according to Trim Tabs. So the insiders are selling their stock out one door while they're using corporate money to buy the stock at the corporate level. So essentially, they're using corporate money to buy their own stock.
So tell me this.
Does that sound shady to you?
Sounds pretty, pretty. I'm put that officially in the not cool penalty box. So tell me this. In light of what you talked about the negatives of old economy stocks, talked about the new economy stocks, and now you're mentioning being a net seller, largely taking your gains from the year off the table. For people who are thinking, well, I was excited about these tech stocks and the short cycle oil stocks until you said you're a net seller. Do you still, I guess you still keep your holdings in those companies, but maybe like kind of how does that balance out before we wrap things up here, if that makes sense?
So very simple. Sell your grandpa stocks, take some of your profits, although you mainly want to keep your winners and get rid of your losers. I know people do it the other way. I'm going to keep this loser until it's even again. No, it's a loser. Get rid of it. Unless you're positive about your thesis, just get rid of it. So take some profits, get rid of your losers, then wait for a stock market correction. You'll have a pile of cash. You should have a shopping list. I have a shopping list I call the very short list over at Margin of Safety Investing and at Fundamental Trends. My 2 investment letters, one's on Seeking Alpha, one's out there in cyberspace. You don't have to always be fully invested. Like I said, we're 25 to 40% cash right now. Why? Because we're taking profits and we're getting ready for the next opportunity. The next opportunity will be the next correction. So control your emotions when things go down, and be a buyer. In the meantime, until then, have a little foresight and take a little skin out of the game.
Awesome. Kirk, great as always. Thanks for joining us.
Thank you very much.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.